Hey, what's up, friends? It's Tyler from Game Plan Financial. If your investment portfolio took a 20% dip today, it would need to take you 5 years to recover that downturn. In this week's episode of On Point, I'm talking all things investment related, but we're taking the standpoint of what you need to do when the market goes to hell in a handbasket, like I believe it probably will do again this year. So the top 10 things you absolutely must do in order to weather the storm in a market downturn is now. So far in my life, I've lived through 5 market corrections, and here's one thing that I've learned. I've learned that the market correction always comes back stronger than it was before, but in between is there a lot of emotion and poor reaction to what people should do financially, and it comes down to great leadership. Let's start off with the top 10 things I believe that you need to do in order to survive a market downturn. They're in completely random order because they're all important. Here they are. Sitting tight is the most important thing that I believe any investor needs to do in order to survive a market downturn. Sitting tight is about pausing. It isn't about staying the course. Staying the course, which many financial advisors like to use that term, is a term, in my opinion, meaning once you're down, you're already down, stay the course. Because if you stay the course when you're already down, you will at least not solidify your loss by taking your investment out. When you're down, right? I've said this time and time again, and so really all you can do is stay the course. But sitting tight gives a moment of pause. It's a moment of reflection, and it allows you to pause, read, and react the current situation, gather resources, and make sound decisions. Staying the course is an apathetic perspective and is often a result of not having a proactive plan or having a proactive advisor. It's kind of the last-ditch effort. So sitting tight is really more an act of stoicism and just really realizing where you're at and looking for resources and collaborating with professionals to get you through this period of time. Buying selectively is very, very important. You are in a market downturn. There's lots of potential opportunity to buy value, companies that are on sale because of this downturn that have long-term growth horizons. My word of caution here is that oftentimes people just want to rush into the market. And it's like a sale at Walmart and they just want to buy everything. And I would urge you that that's probably not the best thing to do. Instead, consider dollar cost averaging into the low part of the market. What is dollar cost averaging? It's putting a little bit of money every month into the market. I would also have you consider this. If it were me, if I was dollar cost averaging and the market was down, I would want to increase the amount that I was dollar cost averaging during that low time. Reason being is because if it's low, we're buying more shares, more units, more stock. When it's down, with the hopes on the upside that when the market recovers, we'll have more exposure to that growth. So I would urge you that when you are buying, buy selectively and consider increasing the amounts that you're dollar cost averaging into. Upgrading the quality of your portfolio is essential. It's a perfect time to take a look at what is actually working well inside your portfolio. So you want to look at the types of funds you have. You want to look at the amount of risk you're taking on inside your portfolio. Is it necessary? Is it unnecessary? Are you paying fees that you don't need to pay? Assessing the quality of your portfolio through a portfolio review with a qualified advisor is a good thing to be doing during this time. You'll also want to look at the types of fees you're paying inside your portfolio. Different funds have different fund structures. There's different commission schedules, and so have a good open dialogue with your advisor to see how you can bring the fees down, because bringing the fees down immediately gives you a built-in rate of return, which will allow you to recover your portfolio faster. During this short-term downturn, have a long-term perspective. Now, when markets go to hell in a handbasket fast, they cut deep, the losses are significant, but know that the markets generally come back. And so have a long-term perspective rather than just look at the downturn that you're currently in and feeling the pain that you're currently experiencing. Look to the possibilities down the road. Whenever the market and the economy does a major correction, it leaves our financial and investment plans off track. Variables have changed, elements have changed inside our lives and our businesses and inside our portfolios. And so the first thing that you'll want to do is make sure that your retirement plan and your financial plan are still on track, giving the new variables that are putting pressure on all of your holdings and ability to earn the income that is needed for daily living. Asset allocation is something you've probably heard of. It's the different types of assets that you have to have inside your portfolio to have a good diversified portfolio and a good mix. Now, when there's a market downturn, that increases risk on your portfolio. It also increases the pressure on your portfolio to earn greater returns. It could also put pressure on you financially, meaning you could be earning less money if you're dependent on your portfolio. And so with all these new changes during a market downturn, it's good cause to take a look at the types of assets that are inside your portfolio and making sure that they are still correct, giving all of the new variables putting pressure on your portfolio. Don't believe that you can time the market. Now, obviously, if there's a known trigger event or buying opportunity, like a major correction of 20 or 30%, it's a pretty good indication that now's a good buying opportunity. That doesn't necessarily mean timing the market. Oftentimes, clients will sell out of everything that they own and go into cash or a GIC and then hold it and then try to time the market on the upside. Now, here's what I know. 20 years of doing this, people that do that miss the boat all the time. They come in late, they don't get the growth, and then they've also really solidified the loss in their portfolio. So if you have a 20% correction and you go to cash and then you try to time the market coming in, I would suggest that it's not going to take you 5 years. It's probably going to take you 6 or 7 years. Do you have that time and duration to try and recover your portfolio? Chances are probably not. And so don't try to time the market and don't listen to anybody who says otherwise. Rates of return are key. We all need them. But if you think that you're going to be getting 10, 11, 12, 15, 20% rate of return, I'd say that you're probably got unrealistic expectations. And so one of the things that I do with all of my clients is we uncover what your expectations are and we walk you through each of those to make sure that if they are realistic, you know that they're realistic and why, and if they're unrealistic, we show you alternatives to your viewpoint. That's a nice way of saying we coach you to the right solution. Studying long-term trends is really not for everybody, but it's something that has to happen. And so if you love all things finance and you love reading and analyzing and understanding the markets, look at long-term trends because they'll give you cause and reflection and confidence of what needs to happen during a downturn. Now, if you'd rather be playing golf or playing with the grandkids and not studying long-term trends, then find a professional who does. A good question to ask your financial advisor to see how well they do at studying long-term trends is to simply ask them, what do you do to study long-term trends? And if they do this, they'll have an immediate answer. If they don't do this well enough, there'll be a momentary pause, and you should know the answer if they have a momentary pause. Perhaps it's time for a second opinion. And finally, remind yourself that after every bear market, there's a bull market, meaning at every bad market, there's a good market. At every good market, there's a bad market, and at the end of every bad market, there's a good market, and at the end of every good market, there's a bad market, and you kind of get my drift. It's the cycle of life when it comes to investing. Know that there's always going to be an up coming up, and there's always going to be a low going down. Well, there you have it. There are the top 10 things I believe you would want to do during a market downturn. I'm Tyler Hoffman from Game Plan Financial, and that's been On Point.